Before I talk about the rest of the topics for tonight's video, I really have to play this clip for you. It's a speech that President Joe Biden gave last week. It is one of the worst pieces of propaganda that I've heard in a very, very long time. So I'm going to play about a 20-second clip for you. You have to hear this. It's unbelievable. I have the corresponding tweet that he also put out along with the speech within a couple days of the speech. But U.S. Treasury Secretary Janet Yellen, President Joe Biden are all repeating this BS economic propaganda that they're going to keep spending trillions and it's not going to add a penny to the U.S. federal government budget deficit. Meanwhile, the amount that the U.S. federal government's going to borrow is increasing from, I think, around $700 billion projected to well over $1 trillion in just the next 3 or 4 months. So I'm going to play the clip right now.
It's fiscally responsible. It's fully paid for. 17 Nobel Prize winners in economics have said it will lower the inflationary pressures on the economy. And over the next 10 years, it will not add to the deficit at all. It will actually reduce the deficit, according to economists.
Wow. That's my Dr. Mark Faber, Dr. Evil laugh right there. I can't believe all the propaganda just in that 20-second or so clip. Unbelievable, the amount of lies in there. I wonder how much these PhD economists, how much extra, if they got paid extra, an extra 6 or 7 figure consulting, and I'm using air quotes here, consulting fee from the Biden administration to sign off on this propaganda, to put their name on it. So let's talk about the topics for tonight's video. It's on the Cantillon effect and more asset price inflation, stagflate, tax lie. The Cantillon effect and asset price inflation and stagflate, tax lie go hand in hand in hand. So this article came out last week. It's citing research from KPMG, the accounting consulting firm, talking about how artificially cheap debt is fueling or turbocharging, as they call it, a mergers and acquisition or leverage buyout boom. The amount of mergers and acquisitions or leverage buyouts is now well over $3 trillion. It's almost to $4 trillion already, but it's projected to go to $6 trillion, which is basically an all-time high. It's right around an all-time high. If it gets to $6 trillion, I think it's occurred once in 2015. Obviously, these numbers, this insane amount of artificially cheap debt and leverage buyouts, it's all started since the Federal Reserve Bank started quantitative easing program in 2008 and 2009, started bailouts. Share buybacks exploded back then too with debt. Share buybacks with free cash flow. If the company thinks their stock is cheap and they're using free cash flow, I think it's a lot more efficient and smarter and better than using share buybacks with debt, because the long-term future of the company, if the company loads the balance sheet with debt, the long-term future of the company is in jeopardy. But a lot of this capital is not being used productively by companies. It's not being used for new products and services. It's not being used for research and development. It's being used for share buybacks with debt. It's being used for inefficient leverage buyouts. A lot of these deals do not work out. Look at the bad acquisitions that General Electric and other large companies have done. A lot of these large acquisitions have not worked out. Sometimes they're written off. Microsoft was famous for this, although Microsoft stock the last few years has done very, very well. But under former CEO Steve Ballmer, Microsoft was famous for really, really bad acquisitions. They were writing off billions of dollars in acquisitions every couple quarters. That's how bad the acquisitions were under the past CEO. Now he's the owner of the LA Clippers. I guess it's a rich person's problem. But all this currency and credit sloshing around with the Cantillon effect, and it's not just in the US, it's pretty much all these central banks in this global fiat currency and credit Ponzi scheme. They're flooding the global economy. They're flooding asset markets with currency and credit, but it's not producing goods and services. So you have lots of currency and credit chasing the same or fewer goods and services. Actually, in many cases, it's a lot less goods than in 2019 levels prior to the pandemic, especially with a lot of these shortages going around. China now has a food and energy crisis. I'll talk about China's food and energy crisis on a separate video. But we're seeing the Cantillon effect just get worse and worse and worse. The distortions, the asset price bubbles. Look at what's happening with these altcoins. Tons and tons of pump and dump. The popular Netflix show, Squid Game, someone did a copy and paste job, a pump and dump with a blockchain code, made a Squid Game altcoin. The Squid Game altcoin went up 75,000% within a couple weeks, and then it just crashed to, I think, almost zero. and I'm sure there's going to be lots of lawsuits. It is a mess. Do you actually think that the Squid Game altcoin had any real value, though? A lot of these altcoins are pump and dump jobs. Right now, the Securities and Exchange Commission here in the United States is not fining or arresting anyone like they would for pump and dump with a stock. It's not happening with altcoins. I've had off-the-record conversations with people that are making $30,000, $40,000 a month doing this stuff with pump and dump on altcoins, working with people who have large social media followings, especially on Instagram. Normally it's attractive women on Instagram with tens of thousands or 100,000 or more followers who are pumping these altcoins, and it's pump and dump. So they've already bought these altcoins for a penny or less. They're pumping these things up, and then when these things go up, them and their boyfriend or their handler, their business partner, are dumping them for tens of thousands in quick profits, and then they move on to the next altcoin. So I don't know how much longer this is going to last, this pump and dump scam, but it is fiat currency and credit, artificially cheap debt, and it's creating all these distortions, all these asset bubbles. It created, remember the special purpose acquisition company, the SPAC bubble. I was predicting for months that the SPAC bubble would collapse. For the most part, it has. There's been some SPACs that have come out with some success, but it's a tiny percentage compared to the total number. Most of these SPACs are dumped on retail investors, and they're a waste of capital, and they're aggressively marketed for pump and dump. So the insiders in the company, the early angel investors, the private equity sharks and vultures can cash out and dump their shares at a large profit onto retail investors. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content, research, financial education, and analysis than I provide in these short little free videos, there are now over 180 articles, charts, and audio podcasts behind the paywall, all for the cost of a Starbucks cup of coffee per month, exclusive for my patrons. And just in the last 18 or 19 weeks, there are 30 new articles out on a lot of interesting topics about global macro companies and sectors, including gold mining, silver mining, precious metal royalty and streaming companies. The precious metal royalty and streaming companies, the larger ones, are increasing their dividends. They are immune from oil and energy price increases, from labor price increases. A lot of the gold miners on the Q3 earnings are getting hit with much, much higher costs. You're seeing this in the Q3 earnings with the gold miners. The precious metal royalty and streaming companies, so your Franco-Nevadas, your Wheaton Precious Metals, are immune to this. They are not gold miners. They do not have the same input costs. Instead of a cost curve like what gold miners have, they have their costs fixed by contract. So it is a way more efficient, way better business model with far safer profit margins compared to gold miners and silver miners and other regular miners. Even the base metal miners and other miners are also experiencing problems with what has been happening with rising energy prices. And also, I'm hoping to get out a uranium update in the next couple days. I have not been feeling well. My health problems are not getting any better. Actually, they've been getting worse the last 6 weeks. Doing the best I can. I know that's not good enough for some people, but it is what it is. So if I could wrap up this short little video very quickly, we're seeing more and more examples of asset price inflation, of distortions of assets, of artificially cheap currency and credit that the Federal Reserve Bank and other central banks and governments have flooded into asset markets, have given to corporations. And corporations are taking this and they're doing, instead of investing in research and development, instead of investing in new products and services, instead of making long-term investments that could potentially create more jobs, they're doing things like share buybacks with debt, with artificially cheap debt. That'll boost earnings so the management team can get rich faster and potentially cash out with golden parachutes and leave the company faster and richer. And then also they're doing now these mergers and acquisitions and leverage buyouts because of how cheap the debt is. They can go and buy some cash flow of a smaller or medium-sized company. A lot of these mergers and acquisitions with leverage buyouts, especially if they're using a lot of debt, tend to not work out very well. In some cases, like with Microsoft in the past, with Steve Ballmer, and General Electric also. General Electric has a long history of bad acquisitions too. These acquisitions are often written off by many, many billions of dollars. In the gold mining space, Barrick Gold wrote off during the gold bear market after 2011. They wrote off over $10 billion in bad acquisitions of gold miners and copper miners that they overpaid for. And the gold mining industry wrote off over $70 billion during the bear market in bad deals from 2011 to 2018. So the Cantillon effect has created enormous amounts of asset price inflation, and because the real economy is not creating anywhere near the amount of goods and services that it was from 2019 pre-pandemic levels, there is a lot more currency trying to get rich quick, chasing fewer goods and services, and also there's financial innovation, financial engineering now, creating new altcoins, and a lot of these are very dangerous to retail investors. Many people are trying to get rich quick. Many people are trading cryptos daily on their smartphones, and there's a lot of pump and dump schemes. Beware of copycats, similar to the Squid Game altcoin, which went up 75,000% very, very quickly and then crashed, I think, down to zero, all within the span of a couple weeks.